Hello there. Today is Wednesday, May 28th, and welcome to the May edition of the Kluge Wealth Advisory Group Client Connect video. In today's video, we're going to cover off a number of segments, including a portfolio update, a brief back to the basics perspective, as well as I'm going to cover off answers to a number of frequently asked questions that we've run into over the course of our client conversations. So let's just jump right into it. So let's talk about a portfolio update for May. Now, we've got a couple of trading days left in May, this being filmed on Wednesday, May 28th. But barring something truly unforeseen, we're going to have a very strong month in May, which is a continuation of the rebound that we saw starting on April 9th. So that's good news. In addition, we have been conducting our usual mid-quarter portfolio review. And so there's going to be a number of changes that are starting to filter through inside of the portfolios. As a reminder, our mid-quarter portfolio review is where we pull apart every single position that we use in the portfolio, evaluate it against alternatives, and determine if we're going to continue to use it. So in terms of what we're going to be changing, so far, we are going to be and have, as of today, traded out of the US low volatility ETF and actually traded into a Canadian equity ETF. Yes, that's right. We have added back some Canadian equity. Now, the rationale on this is that from the perspective of global investors, our new Prime Minister appears a lot more business friendly than our old Prime Minister. And that at the margin will likely see increases in allocations to Canadian equity. So for instance, if you and I were sitting in a hedge fund office in London and we were 1% Canadian equity, while the benchmark is 3%, we may decide that based on the new tone from Ottawa, that we are going to increase our allocation to 2%. Now that doesn't seem like a lot, but when you multiply that over many investors and the small size of Canada's market, that could create a good opportunity where Canadian equity may outperform US low volatility equity. So we think there's an opportunity there and we've moved to address it. Another change that will be coming through is we are going to evaluate a number of US equity positions. However, we haven't made those changes yet, so I'm going to have to refrain from speaking about those directly. But if you are interested, pay attention to your online access system or your monthly statements and you'll see exactly what we're doing. And of course, if you have any questions about any portfolio changes or anything in your portfolio, we're more than happy to discuss it at any point. So in this segment, I want to go back and revive a segment we haven't touched on in quite some time called Back to the Basics. Now, in Back to the Basics, the idea here is just to review some basic ideas around successful investment and financial planning strategies and just bring them back to the front of our minds. Now, given all of the volatility and all of the anxiety and all the fear that we've all experienced here over the last 10 to 12 weeks, I wanted to talk about the negativity paradox. Now, I haven't discussed this before in a monthly market video, but many of you have heard me discuss this. And for those who haven't, the negativity paradox basically breaks down to this, is that despite the fact that the market goes up approximately 75% of the time, about 2/3 to 3/4 of all market forecasters, prognosticators, newsletter writers, etc. are negative on the market. They will perpetually be looking at why the market is going to go down as opposed to accepting the market is likely to go up. Now, I understand when you're looking at this, there's a number of reasons they would do this. Number one is fear sells. The human brain is wired to avoid fear and avoid pain much more than it is wired to seek pleasure. And that makes sense from an evolutionary perspective. It makes perfect sense. The other reason you see this negativity paradox is that in a system that nobody gets, the person saying, hey, let's be careful, sounds smart. However, the outcome is not. With the market up 75% of the time, missing even a few of the best days in the market is extremely detrimental to your wealth. Now, I've got a number of posts up in the last few weeks about this and exactly what the impact is of, say, missing the best 5 days or the best 10 days in the market. But let's just suffice to say for the purpose of this video that it is extremely harmful to your wealth. So don't get stuck in the negativity paradox. And remember, irrespective of how the market is doing today, that we have seen negative events in the past, and yet the market is substantially higher, and we are all substantially wealthier despite that. So, of course, if you'd like to discuss this further, give me a shout. Happy to have a talk. Okay, let's jump into some of your frequently asked questions. Now, initially what we're going to do, as we have done in past videos, is I'm going to give a very, very brief answer to both key questions that we're going to address today. And then in further segments, we're going to go into a bit more detailed answer. So let's get into what those questions are and what the brief answers are. So the first question we're starting to see pop up is about this new US tax legislation that's encompassed in Donald Trump's, as he's termed it, the big, beautiful bill. Now, some of that legislation has the potential to impact withholding tax rates on Canadians owning US securities. At this point, based on some of the analysis I've seen, the impact that it will have on our portfolios are very low because we are not a dividend strategy. We do earn dividends and there could be some increase in withholding, but right now there's not a lot of impact from that. The second question that we've seen a lot of revolves around outlook and some concerns that, that there may be a second shoe to drop. Now, I never want to be in the position of predicting the future, but I think that if we take a look at the bottom line is that based on indicators of earnings, indicators of studies based on sentiment, and studies based on quantitative patterns, that the outlook is very strong. In fact, if you gave me the data set that I'm looking at today, and you told me that 1 year from now the market was 25% higher, my response would be nothing could be more normal, and that is unremarkable based on the data set. Now, I'm going to go into a little bit more depth here in the following segments, but hopefully that gives you a quick shot answer to some of those questions. Thank you. In terms of the question about the potential impact on Canadians from the new US tax legislation, let's get down and break this down a little bit further here. So again, the bottom line here is that at least in terms of the portfolios that are managed here, it doesn't look like there's going to be a lot of impact. The new higher withholding tax rates mainly affect dividend income, which is not something that we're earning a lot of at this point. We do not run a dividend strategy, although all sources of return are welcome. And at this point, so there's very little impact in that regard. Now, based on other analysis that I've seen of this bill, there are potential impacts if you own US real estate or if you have US-based businesses. So definitely in that situation, this is something you want to be monitoring. And I also want to emphasize is that there are a lot of changes that are possible at this point. We're still very early phase. This legislation has only passed the US House of Representatives. It still needs to get through the Senate. And even if it survives that process unchanged, there is a direct off-ramp for these higher withholding taxes if Canada were to repeal its digital services tax. And I can't imagine that this is not something that's going to be discussed in free trade agreement conversations. So again, I think there are a lot of off-ramps to this situation. It is a potential increase in taxation for the United States that we do need to be wary of, but we have to see how things develop and we have to see the extent of the impact once the legislation is finalized before making any moves. In speaking about outlook, I always want to start off any answer that I give by emphasizing that I am not in the prediction business and have no way of knowing what the future path will be. However, we do know that there are very well-established relationships that exist in data, and I can tell you definitely what those data points mean at this point. So the bottom line is that based on the studies of quantitative research, based on studies of sentiment, and based on studies of liquidity, is that I'm very optimistic about the outlook here over the next 6, 12, or 18 months. And the reason for that is that if we take a look at studies of sentiment, we see that investors, especially institutional investors, are extremely negative. And it is a bit of a contrarian positive when investor sentiment is very, very low. Low or poor or negative investor sentiment has always correlated with high future returns. And enthusiastic, high or optimistic investor sentiment has always correlated with low future returns. So we have passed through a period where investor sentiment has gotten extremely negative, and now we're in that process where investor sentiment is beginning to recover, but nowhere near to recover to average levels. So that, from a sentiment setup perspective, is very, very strong. Also, from a quantitative standpoint, the setup is very strong. If we look at the way in which we've recovered off the April 7th and 8th lows, the patterns that are present in price and volume all correlate to past instances where future returns were very, very strong. And based on these studies of sentiment and these studies of quantitative patterns, they both point to returns in the 15 to 25% range over the next 12 to 18 months, which is very, very good. Now, in addition, there's also further backing for this outlook. If we take a look at the price of oil, the price of the US dollar, and US interest rates, we all see that to one extent or another, they've dropped considerably here year to date. And there is a very, very tight correlation between a price drop in the US dollar, oil, and US interest rates and an increase in global liquidity, or if you want to put it a different way, an increase in the available money supply. Now, typically what happens is that when the money supply goes up, about 3 to 4 months later, you see equity markets start to rise. And currently, frankly, we're about right on time. We're a little bit sooner than usual, but we saw the US dollar really begin to drop off in February, oil come under pressure, etc. And that has led now about 8 to 10 weeks later to an increase in a recovery in equity markets. Now, the next thing one would expect is that if there's an increase in money supply, is that money will actually then begin to find its way into the real economy. And there we should see a pickup in economic data start in the late summer, early fall. Typically, there's about a 6 to 9 month lag between an increase in liquidity and an increase in measures like the ISM, which measures factory surveys as well as the service economy. So really what that would say is that if you think of it this way, is that the stock market is anticipating, by going up now, would be anticipating increase in economic activity later this year. And that is driven by liquidity, which was driven by a drop in the price of oil, a drop in the price of the US dollar, as well as a drop in the price of interest rates. And I'll take a moment here to answer one of the obvious question here is why would those things generate liquidity? Well, the reason is that much of the world economy, whether we see it or not, is denominated in US dollars. The US dollar is the fundamental asset of the world economy. And if you need fewer local currency units to buy a US dollar for instance, to buy oil or to pay a US dollar denominated debt payment, then you have more money. And if you have more money, it is very likely that you will invest some of it, you will spend some of it. And so that finds its way both into capital markets and into the real economy. So having the very potent combination of a lower US dollar and lower oil prices, where for instance, if you are selling Australian dollars to buy oil, you need fewer Australian dollars to buy each US dollar, and then you need fewer US dollars still to buy each barrel of oil. So that creates an impact where the purchaser of that oil in Australia now has a fairly large amount of extra money. And that air quotes extra money will find its way either into capital markets or into the economy, which helps pick things up. So this is very important to remember, is that when we're talking about what are the indicators, and we talk about sentiment, and we talk about quantitative pattern, there's also, and we talk about liquidity, there are fundamentals that underlie these things. And these are ways of understanding the way these fundamentals operate. And that's why we're optimistic, is we have sentiment pointing in an optimistic direction, we have the quantitative patterns pointing in an optimistic direction, and we have the level of liquidity or available money pointing in an optimistic direction. So that leaves me with one conclusion: we've got to be optimistic. So if you have any questions on this or anything else, again, please give me a call, and I'm happy to discuss it in any further detail. So in terms of today's video, we covered off a number of things. We did a quick portfolio update, we talked about some back to the basics, and we discussed the negativity paradox, and then we covered off 2 frequently asked questions that we've encountered in our client conversations. One on the new US tax legislation that's making its way through the House of Representatives and Senate, and the second is on our outlook here for the remainder of 2025 into 2026. Now, of course, as we'll say before and we'll say again, if you have any questions, please pick up the phone, give us a call, email, book us on Calendly. Happy to have our conversation and happy to have a discussion about how any of this may impact you and your goals and your future. Thank you very much, and we'll look forward to speaking with each of you soon.